but you'll only miss a minute or so and you don't get penalized for that. If you come to class late, more than half an hour, you may have a problem qualifying for your required 75-hour requirement. So please, guys, come to school on time. It's very important. Also, if there are any administrative questions, where do I find a resource? How do I do this? What's the policy of that? How do I track my hours? What about the test and all that other good stuff? You can always go to recareercenter.com, the school's website, and look up that information. Or you can wait till noon and Lauren or Noel will come online in a live interaction and answer any and all of your questions. However, I am going to ask you nicely that if you do have any questions, that you stick online as soon as we break for lunch so they can answer them. Because if you go away and come back and start asking questions, guys, they good chance may have answered those questions 2 or 3 times already and may not answer the question a 4th or 5th time. So please be courteous to our office staff when they do come online and ask them appropriate questions. If you have any other questions regarding real estate, what we've gone over, or you have a situation or a problem that you're experiencing, you can always stick online after class is over at the end of the day. I'll always take further questions at that time. Whether I can help you or not, we'll see at that moment. And if you have any issues with the school or such that you want to discuss, I will and always do provide my email at the end of every day so you can contact me directly. Whether I can help you or not, we'll see at that time. We take breaks during the day. There's a half-hour coffee break at 10:30. There's a 1-hour lunch break at 12 o'clock till 1. Remember, 12 o'clock is when the admin staff comes on, so stick around if you have questions. And then we have another coffee break from 2:30 to 3, and then the end of the day is 4:30. We will try to get done a little bit early if we can to handle any other questions anybody may have had. Also, as I tell everyone in these classes, it is extremely important and suggested that you pre-read your chapters before you come to school. If you do, I can pretty much guarantee you, through statistical analysis, we've proven this, that students have a higher rate of retention of the information and a better understanding of it. If you don't, and you come to school without knowledge of what we're about to discuss, you're kind of working blindly. And you may have questions that pretty much may be self-evident in the chapter, or it may sound repetitive, the questions you're asking, because people already know those answers and concepts. So please do yourself and the class a favor by pre-reading all this information before you come to school. Now, before I start the review from last week's homework and today's assignment, was there any questions? I'm opening up for questions and answers right now. Was there any questions before we start? Not seeing any questions from anyone. I will be starting. Oh, there is maybe a question, so I'll hang on. No, you don't want me to ask any personal questions? I never do, Amy. But I'm saying if you're discussing with the class not to ask personal questions, they can do that on their own time. Yes, quite all right. Was there anybody else with a question about what we're doing? How do we access the textbook? Open up your page to chapter 14, page 235. I don't know what you mean, Rachel. Hi, this is my first day. How would I know what chapter I'm going to do in prior? We have a schedule. recareercenter.com/schedule tells you what chapters on what days are being presented. Okay, not seeing any other questions, I will moderate the conversation. And I will open it up from time to time. Everybody will tell you, I always open up the conversation from time to time to ask questions about information being presented. If you have questions about other information or things about real estate, wait to the chapter that's being presented. We have 21 chapters over the course of 9 days that are presented to you. And there's probably a class that covers the thing you want to know about, or just wait to the end of the day and I'll answer those questions. Okay, so for your homework review from last night, you were to do chapters 12 and 13, and I will now give you the answers to those. Excuse me. For chapter 12, the answers to the chapter 12 homework quizzes are as follows. Number 1, D for dog. 2, B for boy. 3C, 4C, 5C, 6D as in dog, 7B for boy, 8D for dog, 9C, and 10B as in boy. Again, chapter 12 homework questions are as follows. Number 1, D, dog. 2, B, boy. 3C, 4C, 5C. 6D, dog. 7B, boy. 8D, dog. 9C, and 10B, boy. For chapter 13, the answers to the homework questions are number 1, C. 2, D for dog. 3C. 4D for dog. 5C. 6B as in boy. 7A. 8A. 9D as in dog. And 10C. Again, chapter 13 homework question answers are number 1, C. 2D, dog. 3C. 4D for dog. 5C. 6B, boy. 7A. 8A. 9D, dog. And 10C. Were there any questions regarding the homework quizzes before we start chapters 14 and 15? Not seeing any. I will be moderating the conversation once again, and we will start today's lesson covering chapters 14 and 15. The first chapter presented, chapter 14, is financing one conventional FHA and VA loans. Remember, yesterday afternoon, we had a short afternoon conversation about what are mortgages. Remember those discussions? You know, acceleration clauses, defeasance clauses, satisfaction pieces, and all that other good stuff. Well, today we're going to discuss more about what financing is all about, as well as discuss different general types of loans presented, conventional FHA and VA loans. Excuse me. So, at the end of this chapter, you should be able to describe issues concerning mortgage financing, including various payment plans. You should also be able to distinguish between among conventional, insured, and guaranteed loans and New Jersey homebuyer programs. So let's get busy and start talking. Now, what is all about this mortgage financing? Well, here's the thing, folks. Most people don't have cash to buy houses. Houses are sometimes the most expensive purchase someone ever makes, requiring hundreds of thousands of dollars in buying power. If a person doesn't have that kind of cash, well, then they can't buy houses unless they use someone else's money to buy a house. Using someone else's money creates a mortgage interest. Now, remember what we talked about, what a mortgage was, a financial claim or interest in property backed up by property being offered as collateral for that loan. So when a bank decides to lend a borrower money, the home that they purchase are used as the collateral for that loan. And the mortgage company giving the loan usually requires the buyer to put down some sort of down payment. So many types of loans require 20% down. Commercial loans for commercial properties usually require 30 or more percent to put down. And some loans have as little as 3.5% down payment to purchase real estate today. So everyone who is looking for a house is going to have to put down some sort of down payment and finance the remainder. This is called leveraging your investment using other people's money, OPP. Yeah, you know me, you know what I'm saying. So when using other people's money, the banks, as we talked about yesterday, charge what's called interest as a profit for lending that money. Interest is profit that the bank charges for lending money to buy houses. There's different types of interest that a bank could earn. Interest according to what the rate of interest is the bank charges that consumer to repay, as well as a potential of collecting what are known as points. We're going to discuss that later today, what a point is. Technically, a point, 1% of the loan amount, is prepaid interest. In other words, more profit up front to the bank, so they reduce the risk to lend money. So now, bank charges interest, and depending on the down payment will infer what the loan to value ratio is. So let's take a simple equation. You're buying a house for $100,000, 100K. You are putting down $10,000 as a down payment. Well, that means you're financing or borrowing $90,000 to purchase that property. Very simple math. So this is the purchase price, down payment. Sorry, this is a mouse that I'm using, and I hate these things. So you have a purchase price, a down payment, and a financing amount or mortgage amount. What's the amount financed? $90,000 compared to the $100,000 purchase price is known as a 90% loan to value ratio, LTV. Obviously, if you're putting 10% down of $10,000, you're financing 90%. If you put down $20,000 on a purchase of a $100,000 house, you're putting 20% down, meaning you have an 80% loan to value ratio. And another whiteboard demonstration. What's equity? How do I get equity in property? I want to make equity. Well, first of all, equity is what is left when the market value is analyzed to determine what it is. Let's say the market value in your house is $500,000. Market value less debt. So you owe $300,000 on the mortgage, which means your equity is, in this case, $200K, $200,000. The difference between value minus debt equals equity. That, my friends, is what you need to remember. Value minus debt equals equity. The market value, $500,000, less the mortgage amount of $300,000, leaves the owner with a $200,000 equity position on this property. Value minus debt. Now, before I move any further, did anyone have any basic questions about these topics being discussed? Oh, wait, there's a question. I'm down with OPP. Hey, leveraging is the way to go, my friend. And that just shows you how old I am. All right. Anybody else with a question or comment before we're ready to start? Not seeing, oh, there is. Okay, so hang on. Yesterday it was Devo. Today it's something else. Who knows? What was depth again? I don't know. We didn't discuss depth. We discussed debt. D-E-B-T, debt, not depth. So the more payments you make, the more equity. Well, hang on a second, Kel. Understand your basic idea is correct. However, we're going to discuss a scenario where that may not occur. Can you repeat where the debt came from? That's what you owe on the property. I'm not seeing any other questions, so let me moderate. Oh, there is. What is interest charged on? Again, we talked about it yesterday, but we'll clarify the statement when we talk about it regarding fixed and adjustable rates. So hang on. Some of your questions will be answered very soon, I promise. I'm sorry, Troy, did you have a question? Let me open it up again. No. Okay. So here's a hint, guys. If you have your keyboard or your mouse on the dialog bar, looks like you're answering a question. That's why I stopped class so we can answer your question. So please be conscious about where your mouse is. And if you've got your dialog bar, open it up because, again, we don't want to delay class longer than it has to. All right, let's move on. Now, interest rates change according to what happens in money markets. Many times, interest rates that consumers pay are directly tied to what banks have to charge them to lend the money because it costs the bank sometimes money to borrow. Let's assume that you're going for a mortgage. So right now, interest rates are hovering somewhere around 2.25% to 2.5% for 30-year fixed rates. If you have excellent credit, put certain percentages down, buy certain priced homes, et cetera, et cetera. How do they determine what the current interest rate is? Well, it many times depends on what it costs the bank to borrow that money to lend you. The less it costs to borrow the money from the Federal Reserve or central bank, the less they have to charge you in interest rates. The more it costs the bank to borrow money, the more it's going to cost you, the consumer, and through interest rates that are higher. So right now, the Federal Reserve has kept the interest rates very low for a very long period of time. Now, if you are an economy student or know things about economics, that's not always a good thing, low interest rates. However, we're living in a time where the interest rates today, guys, I'm going to tell you, are unbelievably low. Never before have we seen rates going under 3% for an extended period of time. It's crazy. And I told you yesterday, back in the 70s, people were borrowing money at 21 to 27% to buy houses. My first purchase, I had an adjustable rate mortgage, started at 9.5% and went to 13.5% before it came back down to 11.5%. Today, interest rates are 2.5% or less. Crazy, crazy affordability right now. So what does that mean? That means more buyers can buy property and buy bigger property because it costs less to borrow that money. So interest rates are a direct function not only of what it costs banks to borrow money at, but the current economic conditions in the marketplace, the availability of that money, and the desire for buyers to buy, and the price of those homes, the down payments, their credit worthiness, et cetera, all conspire to set what interest rates are going to be for a consumer to pay. Again, I don't want to go too deeply into that because you're not going to be tested on those other things. And just got a text from I'm having all the windows in my house replaced, and the guy just texted me saying, "Oh, we got a COVID delay at the factory, so we're going to be another couple of weeks." It's getting cold out. I want my new windows. Anyway, So there are various types of mortgage financing available to consumers based on their ability to borrow, their desire for certain type of payments, et cetera, et cetera. There are fixed rate interest loans and there are adjustable interest rate loans. Why people get different types of loans is none of our concern for a test. That they are offered is all we have to remember. So, whether it's fixed rate mortgages, adjustable rate mortgages, seller financing mortgages, hard money mortgages, cash loans, etc., all depend on the buyer's qualifications and the bank's agreement to lend money. So there's conventional FHA and VA style loans, which we will talk about later. Conventional means uninsured, unguaranteed. FHA is a government insured loan and a VA loan is a government guaranteed. Again, we're going to talk about those later. This is just a basic primer on the concepts and terms we're going to be discussing. Now, one of the most important things a borrower must understand is something called amortization. If you are of the Italian persuasion or speak the tongue, morta, if you are a Italian heritage person and know what morta means, it means death. Amortize means to kill off slowly. So your repayment schedule to the bank is spread out usually over, let's say, a 30-year period. And by sending them payments for principal and interest payments every month, you're slowly killing off the debt over time. So when the bank makes a loan with the borrower, the bank gives the borrower something called an amortization schedule. If you look on the top of page 237 of your textbook, there's a diagram, figure 14.1, says level payment amortization plan. Looking at that, I'm going to just try to interpret it real quick. The dark shaded areas are the interest part of the payment the consumer makes to the bank. The light shaded areas are the principal amount of payment they pay the bank. The principal is the amount borrowed. The interest is obviously the profit the bank makes. And by looking at that diagram, you can see very clearly that the bank demands most often that interest is probably the largest contributor to your payment throughout the first several years of property ownership. And the principal payments, the amount you borrowed, are at the back end of the loan. So as a principal payment, a borrower would contribute more towards interest at the beginning of the loan, but at some point their payment starts to contribute more towards principal than interest. And then at the end of the loan, their payment consists of almost all principal payments. This way, the bank takes their profit up front, and the house, which serves as collateral against the principal amount borrowed, when sold, will pay off the principal, or if foreclosed, will be auctioned off and hopefully pay off that principal. Depends on the situation of the borrower. So constant payments over a life of a loan, amortization, result in most likely interest being paid greatly at first, but then diminishing, then principal being paid mainly at the back end. Did anybody not understand the principle or idea of amortization? Not seeing any questions, let's move on. Now, there are different types of payments. There are fixed rate loans. There are adjustable rate loans. Let's take the fixed rate loans first. There are fully amortized loan payments under fixed rate loans. What does that mean? If you look at that chart once again, that means if those were 360 payments, if you could see the payments for each month for 30 years, there'd be 360 of them. You know that by the end of your payment schedule on the 360th month, you've paid off completely the entire debt to the bank. That is a fully amortized loan where your payments over time pay off the entire amount of principal and interest borrowed from a bank. There could be partially amortized loans, where a payment to the bank based on a 360-year monthly payment is then shortened for some reason. We're going to talk about that in a second. There could also be straight payment plans, meaning interest only based on your fixed rate loan, where the payments you make don't cover any contribution to principal reduction, but are for principal only. So what I'm talking about is this: in a fully amortized loan, your payments are designed that over a period of time you pay off the entire debt. In a straight payment plan, you're paying interest only. So how does the bank get paid principal? What they do is have a straight payment plan designed on 360 months worth of payments, but after a certain time in the loan, usually 7 to 12 years, someplace in there, they require that the borrower, the buyer, pay one big balloon payment to the bank for the entire amount of the principal due. In other words, you're getting less than required payments to satisfy the amortization of the loan. However, since the bank's making profit up front through the interest only payments, and that's all they're making is profit, then after 7 to 10 years, if that person sells the house, they could use the proceeds and pay off the principal of the balloon payment due at a certain time. That works great when markets are constant or going up, but it's very risky if markets go down, because remember, you have to pay that principal balloon payment with the proceeds of the sale of the house or through a bank account making a payment. If you don't have the money and the house isn't worth the payment, then you may have to default on the balloon payment and then go into foreclosure, and then you got a whole bunch of problems. So a straight loan, highly risky, usually for short periods of time, always has something called a balloon payment, where the borrower must pay off the entire debt of the principal owed. A partially amortized payment is like a full amortization payment, except just like the straight loan, they have a required early payment, a balloon payment, to pay off the entire amount of the balance at once. I know this sounds a little different, confusing, maybe you never heard this before, but fully amortized loans, the payments pay off the entire debt over time. Partially amortized loan, you're only paying off partial debt, and then a balloon payment satisfies the remainder. A straight loan, you're only paying interest, no principal, until your balloon payment is due, and then you pay off the principal. Before I move on, was there any questions about these types of payment plans? Apparently some, so I'll wait. Why straight loans? Again, we don't have to worry about the whys. We don't have to worry about who borrows that kind of money. It's just that exists is all you have to know about. Partially amortized, after how many years do they pay the big balloon payment? Somewhere around 10 years, Kira, somewhere around that. I'm a little confused about the difference between straight loan and partial amortized loans. Partial amortized loans include principal and interest payments. Straight loans are interest payments only, no principal contribution. Both are requiring balloon payments. Straight loans more risky than partially amortized loans? Yes. Partially amortized loans are risky too, but straight loans are even more risky. Yes. Any other questions before we move? Guys, remember, why people do things is not a concern for your licensing. Why people do things is where your broker trains you. So understand, all you have to do is know about these products being discussed, not why people get them and all that other stuff. Forget that. It's not part of your learning experience. Difference between partially amortized and amortized is less payment. Quite possibly, yes. Are straight loans good for flippers? I'm not going to answer that because I don't think that's a appropriate question for this class. My personal opinion, Viata, I'm sorry, excuse me if I butcher your question, your name. My personal opinion is that you shouldn't even be financing your flips. You should be paying cash. That's my personal opinion, and I'm going to leave it at that. So, Dante, the difference between amortized and partially amortized just by big balloon payment at some point, correct. Anybody else? Michael Bloom, I see you have a typing open, so I'll wait. Or not. Oh, there it is. Nope. Okay. Remember, guys, if you got your dialog bar open, I'm waiting for you. Just remember. All right, moving on. So I did fully amortized, excuse me, straight payments, partial amortized, and now we'll talk about a bi-weekly mortgage. Now, I'm going to use a whiteboard because this is more of a visual concept that sometimes people don't get just by talking about it. If I make one monthly payment, and in 1 year, that means I have 12 monthly payments I make throughout the year. However, since there are 52 weeks in a year, and if I make a payment every 2 weeks, that means I'm making 26 bi-weekly payments, 26 half payments every 2 weeks. Divide that by 2 to determine how many months I pay. I'm paying 13 months in a calendar year as opposed to 12 months. And if I'm paying 13 months in a calendar year, that means I'm paying the debt off faster and I'm saving the cost of interest over those savings of payments that I'm making because I'm making more upfront. So real quick, if I'm paying 12 monthly payments, then I make 12 payments. If I make 13 monthly payments, because if you pay every 2 weeks, 52 weeks divided by 2 is 26 bi-weekly payments. Bi-weekly meaning half payments every 2 weeks. So if I divide 26 by 2, I get 13 monthly payments made in a calendar year. Doing that, a bi-weekly mortgage can save you money on interest payments and shorten the term of your loan by a couple of years. There is an alternative way. And that is if you're on 12 monthly payments per year and you happen to have enough money at the end of the year to make one extra payment, then technically you're making 13 payments a year. However, this one extra payment you make at the end of the year, when you send your check in for principal reduction only, it's a pro payment, I call it. Principal reduction only. Meaning if you make that one extra payment and assign the check towards principal reduction only, then the bank takes the check, that one payment, and applies it to the back end of the loan to reduce the principal amount. Every year you do that, you whittle down the length of the loan by up to 7 years and save yourselves tens of thousands of dollars in finance charges over those 7 years of payments. So if you can, and you're on a 12 monthly payment schedule, make one extra payment per year. Address the check to be paid towards principal reduction only, and then your length of your loan shortens dramatically, and you save a lot of money in interest charges. Did anyone have any questions about a bi-weekly loan or the concept of just making one extra payment and addressing payment to principal? They both work to reduce your debt and reduce that and the time frame it takes. I see a couple people typing. So do we need to know which is best? Not every idea is best for everyone. So you should weigh the cost of your money if you can afford to make those payments, what's better for you. And every loan is specific to the owner. So in the last month, in a biweekly, the last 2 checks should be addressed. No, Rachel. Remember, in a biweekly payment, you're making 26 half monthly payments. You don't have the luxury of addressing the normal payments towards principal reduction. If you want on a biweekly loan and send in an additional payment, then that one should be addressed for principal reduction only, if you can. Does one save more money than the other? Yeah, this one saves more money than the biweekly loan. This one saves more money because you're using an extra payment to reduce the back-end principal quicker. So the 13th payment can cut interest in the long run as well. No, again, the 13th payment are 2 half normal payments. So you don't have the option here of reducing your principal faster. If it's $2,000 a month you paid for mortgages, if biweekly will be 2.0 the first week and 2.0 the next week. I'm sorry, let me understand your question. It's $2,000 a month, then you're making $1,000 payments every 2 weeks, Vivian. That would be the equivalent, not 2,000 every 2 weeks, 1,000 every 2 weeks. Got it. Okay, good. I sent in a check for $10,000 towards principal reduction of my loan, and it reduced my loan 18 months. C'est la vie, baby. There's ways to save money, guys. I'm just giving you one. But yes, if you more the money you put down towards principal reduction, the much shorter the term will be, and the more interest you will save. Can you spend an extra check in any time you want and make it pro? Yes, you can, Michael. Of course, the banks don't tell borrowers this stuff, right? Correct, Kira, but I'm telling you because I'm a seasoned realtor and I want you to know about it, because when you tell your clients this, they go, wow, thanks for telling us. No one tells us about this stuff. Make yourself the pro in your area. How's that? Oh, thank you. All right, anybody else with a comment or question before I move on? I'm not seeing any, so let's move on, guys. Oh, sorry, there may be one or two. I care. Yes, I care deeply. Can you send a principal payment every month? If you can afford to, yes, you can. You still got to make your normal payments. Yes. Guys, remember yesterday we say in New Jersey, there's no such thing as prepayment penalties. So if you want to contribute to pay off your debt faster, the bank cannot penalize you to do that. Vivian, Andrea, I'm sorry. And did you guys have questions? I see your keyboard's open and I'm waiting, so just checking. What does pro refer to? Again, that was my labeling of that extra payment. Principal reduction only. That's what I call it. Everybody else calls it different things. I call it a pro payment. It's just the way I do things. If I can shorten an anagram and describe something, just like the military, right? Okay, Viviana, did you have a question? I see your dialogue bar open for some time. Are you writing a tome or something, or did you just forget your dialogue bar was open? Or did you step away and leave it open? Even worse, then I don't know if you're asking a question. Oh, okay, there we go. Okay. Anybody else with a question before we move on? I do want to move on. And I see Jason, you have a question. Or not. All right, I'm going to move on, guys. Again, please. Oh, there it is. Semper Fi. There you go. I'm not going to go there, Jason. We're just not yet. We can talk about that personally later. But anyway, What I did, I would have to kill you if I told you. How's that? I went advanced killing school. I know about that stuff. Semper Fi, my friend. Anyway, moving on. So we have fully amortized loans, partially amortized loans, biweekly loans, straight loans, all kinds of loan payment plans under fixed rate loans. But there's also something called adjustable rate loans. What's an adjustable rate loan? Well, in a fixed rate loan, the interest stays the same for as long as you make your payments for the entire length of the amortization schedule. The interest rate, if you borrowed at 2.5%, stays the same for the entire 30 years you have to pay back. An adjustable rate is one where the consumer now takes on the risk of a movement in the index that your interest rate is tied to. Wow, so this sounds complicated. Well, it's not for everyone. I'm going to tell you that. It's not for everyone. So let me try to give an example of what I'm talking about. Now, an index is a thing that a rate can be tied to. There may be LIBOR, COLA, coffee indexes, all kinds of weird things, muni bills, T-bills. There may be an index where a bank is basing their cost of borrowing money on. Let's just call it a coffee loan, cost of fund index. The bank borrows money, let's say from the central bank at 1%. So that index of the interest at 1% is what it costs the bank to borrow. If a movement in the index occurs, the bank's not worried about it because it's the borrower who assumes the risk of the index movement. As the index goes up, the interest rate goes up. As it goes down, the interest rate goes down. A margin is what the bank makes as profit. So let's say it's 2%. So the index would cost the bank coffee. Margin, what they charge as their profit margin obviously, equals the rate that the consumer must pay. In this case, it's 3%. That's simple math. 1 + 2 = 3. That was easy. However, this borrower who's getting a rate of 3% is betting that that interest rate stays even or goes down because that would cost them less. But in most and especially today, if you're borrowing at 2.5 to 3% fixed interest rates can really only go up. They can't really go much further down. So let's say the index goes up by 1. Now it's 2% index plus the 2% margin. Now the consumer's paying 4% on the loan. Their rate went up by a full percent. And then on the adjustment period, again, I'll talk about what that is. It goes up another 1. Now it's 3% plus the 2%. Now the consumer's paying 5%. So a fixed rate loan is where the bank takes the risk of index movements. An adjustable rate loan is one where the consumer takes the risk of index movements. I'm going to zero this out and go back to discuss what we're talking about, if I can. There we go. So once again, an adjustable rate loan is where the borrower takes on the risk of the index movement, which costs more money if it goes up, less money if it goes down. Index, what the bank pays. Margin is the bank profit. A cap is the amount that the interest rate can go up or down during a adjustment period. Let me give an example. My first purchase of real estate was in 1985 on a condominium in Ipswich, Massachusetts, 500 Colonial Drive, Ipswich, Massachusetts. Never forget that. My wife and I lived there for about 5-6 years before the economy's tanked in Massachusetts. We both relocated down here. I took a job as a project manager in Manhattan. She took a job as an insurance adjuster down here. Now, what happened was we took an adjustable rate loan. At 1985 rates, the current fixed rate loan was approximately 10.5%. Because I took the risk of index movement, my introductory rate was 9.5%, 1% below the fixed rate loans. So this first teaser rate, I'm going to call it, what the bank offers initially as a below market rate, helps me buy more house because it's more affordable to borrow money. I could borrow more for the same cost, buy more of it. So I bought a bigger condo. However, my adjustable rate loan had a 2-year adjustment period for 3 adjustment periods. So every 2 years, the adjustment period would change. If there was a change, I would have to pay more or less. So for the first 2 years, I paid 9.5% interest when the current fixed rate was 10.5%. I was getting a good deal. But the bank wasn't making their profit margin because, remember, they're giving me a teaser under market rate. So as soon as the first adjustment period end, the cap, how much interest can go up during an adjustment period, was 2%. So now I'm paying 11.5% when the fixed rate's still 10.5%. In other words, now I'm overpaying on interest for the loan, but that's okay. I was able to qualify under the teaser rate and got more house because of it. And if you think about it, after 4 years of payment, I was 2 years under, 2 years over. So really, it was like a 4-year fixed rate loan at 10.5% if you average it out. Now I'm being oversimplistic, but that's how I figured it. But after the second adjustment period, after the 4th year, remember 2-year adjustment periods, I went through 2 already. It changed it from 9.5 to 11.5. That was 1 adjustment period. The second adjustment period kicks in for the second 2 years, and now I'm paying 13.5%. 2 full percentage points it can go up during an adjustment period to cap now how much it can go up or down during a period. The ceiling is what the entire amount of interest can go up by over the total amount of adjustment periods. So on the third adjustment period, the year 5 and 6, the interest rates came down to 11.5%. And we converted at that time to a fixed rate loan to lock in our payment schedule based on the current rates. Most adjustable rates offer a conversion or lock-in period at some point. Now, I just talked to you about an adjustable rate loan where the borrower assumes the risk of index movement, and if that index movement goes up, the consumer pays more. But let's look at the worst case scenario. Remember, the index was 1%, the margin was 2, and my rate was 3 based on the index and margin combined. Now, what happens if the index goes down? Say it goes down 0.5 point. Well, the margin's still being changed. So literally now my payments are based on 2.5% interest rate. Nice, I'm saving more money. It goes down another 0.25 point. Therefore, now the bank's still got to charge their 2. So now I'm paying 2.25%. This is best, man. I'm saving a lot of money. But the bank is projecting my payments at a minimum of 3%, if not more, to make money on the deal. And because my interest rate went down, they're making less money. So when a bank makes less money or not as much profit, they don't like to lose money. So they take that difference and tack it onto the back end of the loan as additional principal. And guess what? Your debt grows as a result of negative amortization. This is serious stuff we have to consider on an adjustable rate loan. The worst case scenario is I get a house at a great rate and the rates go down. Well, the bank's never going to regain their teaser rate out of pocket, so they have to make that up by charging you, not just charging you more money by taking the loss they experience and tacking it onto the back end of the loan as additional principal, and your debt grows. Negative amortization. Did anybody have any questions about adjustable rate loans? Again, that was a down and dirty, very quick explanation. It's not for everybody. It is riskier than a fixed rate loan. For ARMs, how often do interest rates change? Depending on your adjustment periods, and every bank is different in their loans that they offer. So you have to find a bank that's going to work with you in adjustment periods, so you know. If the adjustment rate puts the risk of the borrower, but the rate goes down, then wasn't the risk the lender in their case? No, remember, they pass that risk on to the borrower. So as the interest rates go down, they don't lose money. They pass that risk on to the borrower, tack on that loss as a back-end principal item, and the debt grows. Is negative amortization illegal yet in New Jersey? Not that I'm aware of, Gary. Doesn't the risk the borrower or lender be really depend on whether the interest rate goes up or down? Yes, it does. Yes, you're right, Michael. Ceiling, how long is the period of time? Ceiling is defined as the amount of increase or decrease in total that the bank can adjust the rate over the total adjustment periods of the loan. Does 1% of the margin equal 1% of the interest? No, the margin is what the bank charges a profit. Index is what they tie the rate to. And I said there are many different indexes they can tie it to. If they take on the loss to buyer, there is no reason to take arm risk. Well, Gary, in the times we are living in right now, you're pretty much going to not have lower interest rates on an ARM. They're pretty much bottomed out, in my opinion. I don't know that they're going to go lower. Most likely, if you take an ARM payment now, your rates will go up if the rates go up. Yes, we will cover HELOCs. That will be a discussion today. Don't worry. Worst case scenario is when you have to pay the bank more money over time because they're taking their losses and tacking them onto the principal in the back end, growing the debt. This period that you mentioned where it could lock down as, I'm sorry, is the period that you mentioned where it could lock, known as rate lock. Rate lock is usually when we're going to go over that future, but no, it's usually conversion or lock-in, they may call it. So there may be different terms. Can you convert a fixed rate before first adjustment? Well, first of all, fixed rates are just that, fixed. Can you convert to a fixed rate before first? No, because the bank has to make back what they underpriced the loan at just to get you the loan. So most adjustable rate loans require that you be in the loan for a minimum of X amount of years before you can get out of the loan. Let's see. If they add more principal on the back end, then how can an adjustable save money? Again, Angela, we're not this. Okay, let me stop here, guys. Remember, all you have to do is know about these things, not the what ifs and the wherewithals of who does it for what reasons and all that other good stuff. You just have to know that it exists and that there are definitions to these terms. Other than that, there's no other learning on this topic, just to clarify. But if when ARM payments go down, the bank just cheats you out of what you tried to save via negative amortization. So what is the benefit? Again, we're not going to go there. Just to clarify, a cap is the highest amount rate can go up or down in an adjustment period, correct? And a ceiling is the total amount it can go up or down on in any over the entire length of the adjustment periods. The percent of the margin bank charges can fluctuate for different loans, correct? If it's an adjustable rate, yes. If it's fixed rate, no. Was there any other questions before we move on? Now, guys, I don't want to sound curt or impatient. It's just that we don't have to know about why people do things, etc. It's just that they exist, and you have to know that. Do the percentage of margin banks, okay. Do banks typically add the interest to the back end? Not the interest, but the loss from the interest and create the negative amortization? Yes, they could if it's adjustable rate and they go down. They could absorb it and pass it on the next adjustment period if they want to. They could, and make your rates go even higher. But what if that loss exceeds the adjustment rate cap? Then they may want to tack it onto the back end. Is it better to get adjustable or fixed rate? Arson, that's up to you and your mortgage company to decide. It's not for me to decide. That's a question that you and your lender should decide what's better for you. I can't answer that. All right, I do want to move on, guys. Was there any other questions? Angela, you had a question, so, or not? Is negative amortization illegal in some states? All I know is in New Jersey, it can happen. It's not illegal that I know of in New Jersey, and that's all we're concerned about. We're not talking about other states and their laws and rules and regulations. We're only talking about New Jersey. So I'll allow one more before I move on, because we do want to move on. All bank mortgage loans are based on indexes, fixed or not. Yeah, the bank has to have some sort of idea on how they must structure their margins and loan programs. Yes. Okay, thanks, guys. Let's move on. We do have to move. So we talked about negative amortization. Convertibility is when a borrower in an adjustable rate loan has the option to stop paying adjustable rates and switch to a fixed rate loan. Usually that must occur after the second or first adjustment period occurs. Depending on the loan, depending on the bank, that will be specified in your loan program when you take it. The initial interest rate, I told you before, we call it a teaser rate, the under market interest rate they whop you into by giving you a break on the interest to start. But then you know that after the first adjustment period, you're going to have to boost up to a level that's going to recoup those losses to the bank, and then they don't have any negative amortization going on. Most adjustable rate loans after 1989 are not assumable. Just remember, they're most likely not assumable, and adjustable rates are typically for short-term ownership, 3, 6, 7 years, then out, something like that. All right. Now there's hybrid mortgages. What? Where you get a combination of fixed rates and adjustable rates. So your first 5 to 7 years or so are going to be fixed rates, and then it switches to an adjustable rate. Well, who in their right mind would get that? Who cares? That it exists is the only thing you have to remember. And then annually, that rate may adjust for the balance of the loan. So if you get a loan today at 2.5% and over 30 years, the rates start climbing, you keep paying more and more as the rates climb at an adjustment of once a year. Who wants that? I don't know. That it exists, that's all you got to know. I've never seen a borrower take a hybrid mortgage like this, but that it exists is what you need to know. All right, moving on. Interest-only loans. Remember we talked about a straight loan, where all the borrower does is make interest payments. That's a good idea if it's a short-term financing. Let me give you a scenario of someone who get an interest-only loan. Let's say I'm a very progressive CEO of a corporation. And because of that, they like me putting out fires and doing things of leadership in various areas of the country in their corporate structure. So they send me to New Jersey to work in their offices for the 5 years I live here. Then they're going to send me to Chicago. 5 years later, they're going to send me to Dallas. 5 years later, I go to Denver. You know how it is. Which means I still need a place to live. So as a busy CEO of a company, I'm usually pretty well heeled as far as my bank account goes and the cash on hand and my ability to put a down payment. So I see $1 million property. Of course, I'm going to have a nice house, because if I'm entertaining, people have to see my worth and how I'm so influential because my company is so important and all that stuff. So I have to buy a nice big house. The affordability of a house with principal and interest payments can be very steep. But what if I only paid interest while I lived there? no principal payments, then it becomes very affordable. So in reality, I can buy a big house for very little money out of my pocket per month. And if I'm moving in 5 years, sell the house, take the sales price, pay off the balloon payment, and be done, and maybe make some money and move on. If the market is good and stays the same or goes up. But if the markets go down, then this interest-only payment becomes very risky, because at some point I'm going to make that balloon payment. And if the markets go down, then I'm going to have to take money out of the bank to make up the difference of what the bank is charging versus what I owe. So understand, guys, interest-only loans are very risky. Most likely an interest loan is a short-term financing arrangement. It's usually never for long-term plans. And where there's are types of loans we're going to talk about that could be making interest-only payments. We'll talk about those later. All right, so let's move on. Interest. I told you interest was what the bank charges for lending money. Profit. That's what interest is, profit. We talked about what an amortization schedule is. You can, as a consumer, when you buy a house, use your amortization schedule the bank gives you to make sure that you're paying the right amount of interest and principal per month, and as a guideline to tell you how much interest on the mortgage that you paid in 1 year was, so that you can reduce your tax exposure. Under the Tax Cuts and Jobs Act of 2018, consumers can write off all the mortgage interest that they owe on a house with a cap now. I believe it's $750,000 for your one property, and it may be $1.5 million for combined investment properties. And one of those is a limit in some instances. I don't fit that category. I don't have $750,000 of mortgage interest I'm paying. And the second bullet item under tax deductible interest on your screen says, and it's incorrect, it says limits deductibility of home loan interest to $10,000. What that's supposed to say is limits deductibility of home property taxes paid in a year to $10,000. Prior to 2018, whatever you paid in property taxes was deductible against your income. But as of 2018, that's limited now to $10,000 a month, which benefits like 90% of the country, but it's not good for us here in the Northeast and the industrial regions where there are very expensive property taxes. I pay close to $13,000 in property taxes a year. I used to be able to write off the full amount against my income. Now I'm only limited to $10,000 as a write-off for my property taxes. I still can write off 100% of any mortgage interest payments I make as a deduction against income, but now I'm limited to $10,000 in property taxes. In essence, I'm paying more taxes here in the Northeast for my property because I'm only limited to $10,000 reduction against income from property taxes. And this Tax Act of 2018 also ended the interest deduction for home equity loans unless the loan is used for home improvement, then you can. So many things changed in 2018 about your ability to reduce your income by tax deductions. You have to know what they are, and if you need to, consult a tax advisor. Any questions on this concept or what happened in the Tax Act? Wait. Okay, Chelsea, I'm waiting. Limits deductibility of home property taxes to be paid in a year or a month, in a year to $10,000. Was there anybody else with a question? Now, this Tax Cuts and Jobs Act is new in the 14th edition. It doesn't matter because you're not going to be tested on it. I promise you. It's just that for your edification, we're talking about it. What charged in the mortgage interest payment in 2018 Act? What changed? What changed was the limit of property taxes you can use for write-offs, plus the total amount of mortgage interest if you own multiple properties, as well as the ending of the home, the interest write-off on home equity loans, unless the debt is used for, unless the loan is used for home improvement. Okay, not seeing any other questions. Let's move on. Points. I made mention of points earlier this morning. Points are prepaid or upfront prepaid interest that the bank charges for certain requirements. Many banks call these discount points. And 1 point, let me specify exactly what we need to talk about. 1 point is equivalent or equal to 1% of the loan amount. So in other words, 1 point equals 1% of, let's say you're borrowing $240,000. Therefore, 1% would be $2,400 would be 1% of a $240,000 loan. So 1 point equals 1% of the loan amount. Not about the purchase price, not about anything else. 1 point would be equivalent to 1% of the loan amount that you're borrowing. Did anybody not understand that concept? Because if you don't understand that concept, we're going to be lost for the entire next week. It's not hard to understand some of these concepts, guys. Is the point calculated before or after the down payment? After, because it's based on the loan amount. Let me reiterify this again. I'm buying a $100,000 house. I'm putting 10% down, which means I'm financing $90,000. So far, so good, or 90% LTV, loan to value, right? Because they put 10% down. If the bank requires me to pay 1 point against that, I have to multiply the mortgage amount, not the purchase price, by 1%. In this case, I would owe $900. 10% would be 9,000. 10% of that would be 900. So 1 point is equivalent to 1% of the loan amount, not the purchase price, the loan amount. Did I make that clear now? I hope it was clear. Charles, we went through the use of the amortization schedule about a good half hour or 45 minutes ago, so no, I'm sorry. I really don't want to go back and start repeating things all over again. Tim, I have to leave. Well, we'll have to take the chapter another time. Okay, good luck to you, Lisa. How many points can the lender mark up the loan by? Well, that depends. Good question. That depends on how good the credit is, how much of a down payment, the purchase price, your earning potential, your bank account, all kinds of things, your credit scores, etc. So I'm not going to say, oh, they have the right to charge this amount of points. Every loan is different. Is there a cap on point? Again, every loan is different. And points are only paid at the beginning when you take the loan. There are no other points during loan period. Yes, but it's for the lowering the loan rate. Not necessarily. Again, everybody calls these discount points or buy down points. What if it's not to get a buy down, but just to qualify for a loan? Then it's not a buy down point. So again, not all points are used to buy down interest rates. It may be just to qualify for a loan. All right, I do got to move on. I do need to move on. So again, one more time. Points are prepaid interest that you pay the bank for a certain condition of the loan. 1 point is equivalent to 1% of the loan amount. So I'm going to give you a quick math question. Someone wants to buy a house, $300,000. They're putting a payment of 20%. And the bank requires 3 points to qualify for the loan that they're going to get. How much do they have to put down? Not only that, how much are 3 point equivalent to? So go ahead. Somebody give me the math question. Answer that for me. Now, look at that. Angela, Alex, Michael, you all got it real quick. Wasn't hard, was it? Now, here's why people got it so quick. And I'm going to moderate the conversation. And I appreciate the input, guys, I did. Because you're buying the house for $300,000, that's the purchase price. Your down payment, 20% or $60,000, right, is equivalent to 20% down payment. That means the loan amount is going to be $240,000 times 3%, because 1 point is equivalent to 1% of the loan amount, and you have to put 3 of those points down. 1 point equals $2,400 times 3. 240,000 times 3% equals $7,200 that you have to put down as points that you have to pay the bank just to qualify to get this loan. So guys, remember, 1 point is equivalent to 1% of the loan amount, not the purchase price, the loan amount. And then depending on how many points you have to pay, just calculate the number of points times 1% of the loan amount, and you'll know how many dollars those points are equivalent to. Again, I don't want to make more of this than necessary. We don't want to make a mountain out of a molehill. It's just that we have to understand what points are, because they're prepaid interest that the bank may require up front. And the fact that we can ask the seller or the buyer to pay those points. What? Yes, we can sometimes ask for seller concessions at closing. Buyer requests seller concede $5,000 for closing costs at the closing. Meaning, if the bank charges 2 points on a $250,000 loan amount, $5,000, then you're having the seller pay it for the buyer so they can qualify to get that loan and buy that house. The buyer could also pay that. But in some cases, we can ask the seller pay for things, and sometimes they will. Now, a rate lock is something that you can qualify for with your lender when qualifying for the loan itself. When borrowers apply for loans, and if you have an adjustable rate loan, they may offer you a rate lock or conversion of that loan, or when applying for a loan, to guarantee a rate lock for you for a period of time so you know exactly what your interest is going to be and qualified for over a period of time. So again, a rate lock is where the bank just says, at this point, your rate will be guaranteed to stay the same if you choose to go that route. And if so, it may be for the life of the loan. Again, don't want to get caught up too much in points or anything like that. It's just that we have to understand there are many different components into what a mortgage is. So there. I'm sorry, Jason, you had a question, so let me open it up real quick. Jason DeAngelis. Where did I get the $240,000 from? From 20% down payment off the purchase of a $300,000 house. 10% would be $30,000, 20% would be $60,000. So purchase price of $300,000 minus $60,000 down payment equals a mortgage loan amount for $240,000. Can seller raise price by price equal to points so seller can say points to make, I'm sorry. Can seller raise price by price equal to points so seller can pay points to make sure buyer qualified? So you're asking that once a deal is negotiated, the seller can now change that amount? No, Gary, no, we wouldn't do that. I'm sorry, maybe I misunderstood your question. And is that another question, difference between fixed rate and rate lock? Well, then fixed rate would be what it costs you over the length of the loan to pay for your interest, and it stays the same. A rate lock is where you may have an adjustable rate and then qualify to have it locked in, or when applying for the loan, if they approve you, they will lock in a rate guaranteed to you for a period of time. So if you buy a house, you know what your costs are. So why did you go do after to get 7,200? I'm really terrible at math. Oh boy. All right, let me moderate here, guys. I'm going to just go through this one more time, and then we do have to move on. So the example I said, you're buying a $300,000 house. That's the purchase price. The borrower's putting 20% down payment. So 10% of the purchase price would be $300,000. 20% would be $60,000 down payment. Therefore, they're financing or getting a mortgage for $240,000. 1 point is equivalent to 1% of the loan amount, in this case, for $240,000, or 2,400. And we said there was 3 points required. 2,400 times 3 equals 7,200. That's how I got the 7,200 and the 240,000, etc. So again, I don't want to go through this all over again. It's just that I hopefully will clear that up. So guys, we do have to move on. I got 10 minutes before we take a break, and we're not even halfway through this chapter. So understand, guys, we do want to get this stuff in, but I don't want to dish you on the questions. So I will open it up for only 1 or 2 questions. So please be pertinent to our discussion. I was trying to I'm sorry, Ayana, I'm not going to do it again so you can take a picture. Thank you, Nicholas. You put it in words for us. There you go. Anybody else? No? Then let's move on. All right. Buy downs is where a bank may ask a borrower, since they may have poor credit or their job is, not a high paying job and they're having trouble qualifying, to say this: listen, because your credit, you have to pay a higher rate than anybody else because your credit's not so great. Instead of getting 2.5%, we're going to charge you 3.25%. However, if you want to, and we'll charge you then, let's say 3 points at closing, you can pay those 3 points to get yourself a 2.5% loan. In other words, the points are used to buy down the interest rate from the bank, so you have a lower interest rate over the entire length of the loan, which is going to save you thousands of dollars. However, and this is very important to understand, you have to pay these points at closing up front, prepaid interest or profit to the bank, which means they have less risk, then they'll give you the better rate. You're buying down the interest rate. But at some point, are those points actually worth paying up front? Think about it for a minute. Let's say you do have to spend $7,200 up front, 3 points, as a qualifier to get the loan. And because of that, or as a reduction, you're buying down the interest rate with the bank. Either or, you're buying down the interest rate, let's say. Instead of 3.25, you're paying 2.5 with the points. At some point in the future is where you'll start saving money on the reduced interest rate. You're not going to start saving money now because of the out-of-pocket expense. You paid $7,200 today. That means you're out of pocket $7,200. You're in the hole. I could have taken a higher rate and saved the $7,200. However, I chose to pay the $7,200. So at what point in the future, through a reduced interest rate, will I start realizing a savings? That could be several years down the road. So if you're paying these 3 points up front to get the lower rate, and then you move out of the house in 4 years, you just wasted $7,200 because you're not going to return that to you in a savings in that short period of time. It may take closer to 10 years to realize the savings of $7,200 in a lower interest rate over time. So understand, guys, there's a trade-off here. Number one, there's opportunity costs of money. What could I otherwise use that $7,200 for to be more productive? Then there's the time frame of the savings realized through the interest reduction. How long will it take me to actually realize the savings by spending $7,200 today and reduce my interest rate? It may be 7, 10, 12 years down the road. And if it's that long, maybe it's not worth paying, because what if you sell a house in 5 to 7 years? Then you didn't save that money. So understand, guys, there is a trade-off here. Do I pay the points up front? And if I'm not going to be in the house that long, at what point will I start saving money? So if I'm not in that long, I won't save money, so I won't pay the points. Or I plan on being in the house for 30 years, then pay the points and reduce your interest over the 30 years and save money. But that's something each qualifier, each mortgage applicant should determine for themselves if it's worth it or not. So a buy down is where the borrower or seller can provide to the bank points up front in exchange for a lower interest rate, which actually helps the buyer qualify to buy more property. The term PITI payment refers to the mortgage payment you make to the bank. We talked about principal and interest through amortization. You have to pay that back. But in most cases, the bank also wants you to pay any property taxes in your mortgage payment to them. That way, when a quarterly tax payment is due, the bank sends in a check and your taxes are covered for you. If you do that, the bank then in New Jersey, and we're only talking about New Jersey, charges you 3 months of escrow payments in advance of closing to keep in escrow, plus your monthly contribution to the tax payment every month, so that they have enough money to pay your taxes and an extra quarter that's left in reserves should you default for some reason on your payments. So your taxes, your property taxes, you have to pay to your bank in a monthly payment as well. So PIT, and then there's the I, insurance reserves. What's that? Well, as we're going to discuss in a few minutes, the insurance reserves is mortgage policy insurance if you don't meet the terms and conditions of a normal conventional loan. And we'll discuss that after lunch or after our coffee break. But again, every borrower who buys usually has to make a PITI payment, principal, interest, tax, and insurance to the bank every month, out of which they pay your taxes, apply the principal and interest to your amortization schedule, and any insurance premiums you pay are directed to the bank to insure against loss. And we're going to talk about those things later. But again, any questions about buy downs or PITI payments? Apparently there's some. There you go. There you go, Orson. Thank you. Putting it all down in writing again for us. Great. Anybody else with a question? PITI payments are a must on every mortgage loan? Not necessarily, Kira, because it's usually, well, it depends on the program you get. And that's why I want to save that conversation to after our coffee break. It's much more than a yes or no here. Fixed rate equals same rate entire loan. Rate lock equals same rate. Rate lock means locking into a specific rate then at some point. I don't understand why a buy down at a lower interest rate won't result in paying off the principal faster. I'm not sure what your question's asking. Can point fees be tacked onto the mortgage amount? You mean, can you finance the points? No, those are prepaid interest to the bank. That's what a point is, prepaid interest. So you must pay those at closing. You can't tack them into the mortgage amount. All right, guys, let's take a break. It's 10:30. It's time for a coffee break. At 11 o'clock, I'll rejoin you. I'll leave the conversation open. Do whatever you do. Please, no links. That's all I ask. And we'll resume our conversation at 11 o'clock, and I'll see you then.
it's hard to figure out how to do those things. So,
All right, we're all set. Thank you.
alrighty, bye.
All right, we'll wait another minute or so. We still about half our students have logged back in. We'll wait another minute until everybody's back here. Sorry about the inconvenience, guys. I don't know what happened. Just one of those electronic phenomena. Hey, I put my star up to show that I was safe, so I'm good. So, hey, it happens. Technical stuff happens, guys. It's just another bump in the road. We get over it and go and move on. So, again, I'll wait another minute. We still have a good half our class still coming back in. Somebody post a bail, please. All right. So, is anybody seeing me? Is anybody hearing me? Can you see me now? Can you hear me now? Just checking. Yes, okay. Phew, we're good to go. All right. So we'll hope that the rest of us join the conversation, but we do want to keep moving on. Apparently, I was speaking for like 12 minutes and I had no idea that nobody saw me or heard me. Crazy. All right, so can I go back? I don't think we moved anything, but I'll go back. 2 slides. There you go. 2 slides. Your home loan toolkit. So that's where I started the conversation. So why don't we continue in our conversation starting now? This is where we picked up after the break. So you didn't miss anything if we're starting from this point. What chapter? You're joining us now? You mean you missed 2.5 hours of class? So you're not getting obviously credit for the half day. You're just coming obviously to fill in your information, but you're not getting credit because you're just joining now. And we are on chapter 14. All right, so after the break, I started talking about your home loan toolkit. So let's do that again. So I'm going to moderate the conversation and move on. So your home loan toolkit, what is that? So anytime someone makes credit application, excuse me for a second, guys, sorry. So anytime someone makes a credit application for a loan, as soon as they complete their application, that lender is required to give that applicant within 3 business days after the application is complete, a booklet called your home loan toolkit. It is required that all creditors, when people are applying for mortgages, that within 3 business days after the mortgage application is made, that the lender provides the home loan toolkit to the consumer. The lender is under no obligation to explain the terms, conditions, concepts, and ideas that are presented in the toolkit. Therefore, when people receive these booklets, they have questions. There's no requirement for them to explain. You can download this booklet from the web addresses that are posted on page 243 in your 14th edition booklet, your textbook. There's English and there's a Spanish version. I suggest you download at least 1 or 2 of those. The reason is because the lender's under no obligation to explain these things. They're going to come to you. I said, hey, Mr. Realtor, you're our agent. The bank will tell us what this is about. Can you explain this stuff? Well, there are very easy topics that are covered in the book. Topics that explain how to determine affordability, how credit scores affect the availability of mortgage money, how to choose best mortgage and down payment, understanding trade-offs between points and interest rates, the value of shopping several lenders, and how to avoid pitfalls and problems. Those are the topics covered. Now, along with this booklet, the lender also provides an initial loan estimate so the consumer knows what the cost of borrowing that money is going to be and what the payment plans are going to look like. They're also going to supply a copy of a sample closing disclosure, which shows the borrower how the accounting is made at closing of where all monies come from, where they go, who pays this, who gets a credit for that, and all the other good stuff. So under this process, when making an application to a lender, that creditor, the lender, must give the home loan toolkit along with the initial loan estimate and sample closing disclosure to that borrower within 3 business days after application of mortgage is complete. And that's where we found out when we were missing no video and audio. So I just repeated everything that you missed out on. Did anyone have any basic questions about the Your Home Loan Toolkit? Because we're now going to switch to conventional FHA and VA mortgages. Do we need to know what happens if the lender does not give it within 3 business days? Well, then you have to report them to the Consumer Financial Protection Bureau, because that's who mandates it. What happened with 2 of 3? Don't understand your question. I can hear him but can't see him. Please, guys, tell me you can see me, please. Yes, you can see me, so good. It's not me anymore. So if you're experiencing technical issues, they're on your end, and reset your connection. That's all. All right, so someone asked, I'm sorry. Oh, maybe I can't see what people were asking. So everybody's now logging back in and saying yes. Okay, good, fair enough. Thank you. So I'm gonna moderate the conversation again. Moderate. Do we know why lender is not obligated to explain it? No, just that the fact is that they're not. That's all you gotta know. Can you open 1 of 3 and 2 of 3s? I don't know what that means, Selkin. All right, I'm gonna move on. Okay. Conventional loans. We're changing gears and moving on. Conventional loans. Conventional loans are any consumer mortgage loan that a bank and a borrower are involved in. It is a 2-party transaction, you and the bank. That's it. Okay, I got to stop here. Apparently, there's people trying to ask questions. Guys, forget the missed technical issues. We're moving on. So please, if you have a pertinent question to be being discussed, and ask. If not, I'm moving on. I'm sorry. Christopher Cannon, your dialogue bar is open. Asking question. Arson, you got a question. What's your questions? If you don't have questions, please close out your dialogue bars, because I'm waiting for your questions. All right, I'm not covering last chapter. I'm talking about what's going on today. All right, I got to move on. Sorry, guys. Please understand, guys. Christopher Cannon, your dialogue bar is open. It looks like you're asking a question, and because I've been delaying class, so if you don't have a question, then please close your dialogue bar. And guys, we're only answering questions about things being presented today. If you have a question about stuff being from yesterday or whatever, ask me at the end of the day, Arson. I'll be more than happy to answer your question at that time. But right now, we're moving on. All right, so a conventional loan, as I said, is any mortgage loan that's a 2-party transaction, you and the bank. Typical conventional loans require 20% down payment on the borrower's behalf. Now, not all conventional loans require that, but typically they do. So if a borrower has less than 20% down payment, the bank will require that, along with their principal and interest and taxes, they pay a private mortgage insurance premium to the bank. Now, under a conventional loan, once again, if you're putting less than 20% down, the bank on a conventional loan requires private mortgage insurance paid by the borrower on their mortgage payment to the bank. Why? Because under a conventional loan, the bank feels comfortable with a minimum of 20% down payment or equity investment in a property, and that an 80% LTV loan to value would be a normal scenario, and the bank feels well enough protected with minimum risk that if the borrower defaults, they can sell that property at auction and regain their 80% loan to value that they lent the borrower. Now, that doesn't relieve the borrower of any uncollected interest or other charges. It's just that they feel comfortable in regaining the principal lent, and then they'll go after the borrower for the deficiency judgment, as we talked yesterday. A two-party transaction. Conventional loan is a two-party transaction if less than 20% down payment requires private mortgage insurance. Now, under the Consumer Financial Protection Bureau ruling of 1999, banks are now required to stop charging private mortgage insurance on a conventional loan when the loan to value ratio meets or goes below 78% LTV. Meaning, as soon as that borrower achieves a 78% LTV, they can stop paying, and the bank must notify the borrower when that happens. They must stop paying the private mortgage insurance and reduce the cost of the loan. So did anybody have any basic questions about conventional loans as presented? Excuse me. All conventional loans have PMI if the borrower hasn't put down 20% or more on the loan. Yes, as soon as the borrower hits a 78% LTV, the bank's required to stop charging the private mortgage insurance. Ow. I'm sorry. How much is PMI, or does it, I'm sorry, I lost the question, or does it vary? Based on the amount of the outstanding debt, they charge a percentage. Regardless of LTV, doesn't PMI have to be paid a minimum of 2 years? Not necessarily, at least, because let's think about this. Let's say I'm putting 15% down a property. I have to pay PMI, obviously. But what if the markets skyrocket? And in a year's time, I go to the bank with a new appraisal that shows my house is now at a minimum or maximum of 78% LTV. If they agree through an appraisal that's correct, then they have to stop charging the PMI. So when are they required to stop charging PMI? As soon as the borrower reaches a 78% LTV. Sorry, you can't. Can you explain what I missed? It due to connection, don't have to get into depth, but what is conventional loan? All right, one more time, guys. I'm going to moderate the conversation, move on. A conventional loan is a two-party transaction, you and the bank. There's no other entity, no other agency, no other government entity, anybody. There's nobody else in the conversation. It's just you and the bank. If you put 20% down or more in a conventional loan, then all you pay is principal, interest, and probably taxes. And here's the other thing. Somebody asked before, under what conditions does a bank charge taxes? The usual scenario is under a conventional loan, if you put less than 20% down on the purchase of property, then you're required to escrow tax money with the bank and pay the monthly taxes, and the taxes are paid by the bank. However, if you're putting 20% down or more on a property, then the bank does not require you to post escrow money for taxes and collect the taxes. You can opt to pay them on your own. So there is an option for those under a conventional loan with 20% or more down payment to pay the taxes on your own, not pay them to the bank. And because of that, your pity payment can vary by lender depending on how much they put down, how much they're LTV is, et cetera, et cetera. It's based on the outstanding balance of the loan amount that's charged as a percentage for the PMI, private mortgage insurance. And again, by the Consumer Federation Protection Bureau, since it's a two-party transaction and you are minimally at 78% LTV or less, then the bank is required to stop charging you the PMI. So there we go. Quick recap. We're back up to speed. Anybody have any additional questions? All right. Looks like there's, oh, maybe there are a couple questions. I'll hang on. Andrina, you have a question. Can you, okay, I'm sorry if I butcher your name. Eviata, I'm going to use that. Eviator. Can you refinance and get rid of the PMI? Call me Evie. Okay, we'll do that. Here's the thing. Yes. Why would you refinance a conventional loan if you're going to be paying off the PMI anyway in a short period of time? But again, you could, if you have more money to put down, you could refinance. But that's up to the borrower, I guess. All loans, PMI, if there isn't 20%, all conventional loans charge a primary or a private rather mortgage insurance if you do not put a minimum of 20% down. How is conventional loan different than a fixed or adjustable? A conventional loan could be adjustable or fixed. But again, a conventional loan is a two-party transaction. That's all that you have to remember. You and the bank. If you want to hang on and let me explain what FHA and VA loans are, then you'll understand what I'm talking about. So Andrina Batista de Cespedes, your dialogue bar is still open. Are you asking a question, or did you forget you had your dialogue bar open? And if you stepped away, you wouldn't know that it was left open, and we're waiting for you to come back, which is delaying class. So Andrina, what are you doing? This is frustrating as a instructor, guys. I want to make sure I don't diss anybody by ignoring their questions. But in the same token, guys, please be responsible in keeping your dialogues bar closed unless you got a question. This is another example of a problem we have that I can't control. So let's move on. I'm sorry for the delay. All right. FHA loans, different from conventional loans in that an FHA loan is you and the bank and the FHA. So now there's a third party in your transaction. You, the bank, and the FHA. The FHA is the Federal Housing Authority that works on the Department of Housing and Urban Development. What they do is they offer to banks who make the loans to insure against loss of equity should the borrower default. What was that? Remember, under a conventional loan, if you don't put 20% down or more, you have to pay PMI. That's to protect the bank against loss of equity should you default on the loan. So here's an example. You put 10% down, you borrow 90% LTV under a conventional loan. You have to pay PMI until you hit 78%. But what if you default on that loan after a year? Well, then the bank's going to foreclose on you, take possession of that property, and auction it off to the best investor that buys the highest price. They're going to take any money garnered and apply it towards the principal to pay off the debt. But if it's not enough and they have an exposure due to the low down payment that you have, then the PMI, private mortgage insurance on a conventional loan, will pay that bank for the difference of the loss amount over the 80% LTV. Therefore, the bank protects itself against the loss of equity by ensuring that the borrower pays PMI until they reach a 70% LTV, 78%. Under an FHA insured loan, the buyer through the bank, buys or gets a mortgage. Now, the FHA doesn't directly lend money. They offer the program to the bank. And what they say to the bank is this: we'll provide programs that your borrowers would like a 3.5% down payment consumer loan to buy a house. But since they're putting very little down, there's a very large window of exposure of loss should the borrower default. But don't worry, Mr. Bank, because the FHA is going to act like an insurance company by charging an MIP, a mortgage insurance premium. The FHA loan charges a monthly rate based on the outstanding balance of the loan for the life of the loan, as well as a premium at closing. And that FHA loan with the MIP will pay the bank off up to 20% equity portion should the borrower default. So it's like an insurance company to the bank. Instead of charging PMI through the FHA, they'll charge MIP, but it's good for the length of the loan. It's not terminated after 78% LTV. It's for the life of the loan. Wow. But what typically happens is a first-time home borrower with 3.5% down payment, 96.5% LTV, pays MIP on an FHA loan. As soon as they get to a 20% equity portion or an 80% LTV, they'll refinance or under conventional loan, pay no PMI, and reduce the cost of that loan dramatically. So understand, guys, conventional loans, two-party transactions. FHA, three-party transactions. The FHA acts as an insurance company, protecting loss of equity should the borrower default up to 20%. Is there any question about FHA insured loans? Andrina, your dialogue bar is still open. I'm assuming you're stepping away and have lost connection with us or something. That's kind of frustrating for me, just so you know. I don't want to diss anybody again, but I do want to answer your question. Thank you, Andrina. Thank you. Why does 203B most popular mean? So the 203B FHA program is where a borrower only has to put down 3.5% down payment, which makes buying houses much more affordable for the masses. So more like what make 203B the most popular, that's the reason, low down payment, 3.5%. FHA is borrower, no. FHA is an insurance company. The bank lends the money to the borrower. All right, no worries, Andrina. Just keep an eye on that. Make sure your dialogue bar is not open unless you definitely are asking a question. I'm sorry, what was your question then, Ayana? FHA is borrower. They can't be the borrower. They're a supplier of an insurance policy. So that's my not understanding. MIP would be much higher than PMI. It does add cost to the loan, yes. Is it higher than PMI? I don't know. I can't do a side by side unless we have a direct comparison loan. But in reality, yeah, it is, because it's for the life of the loan. Plus, you have to make a premium payment at closing. I'm saying the 3 points of the FH. I don't understand that comment. Sorry, Ayana. Guys, please, if you got a question or comment, write a complete statement or question so I can understand what you're inferring. I'm having trouble with partial statements as complete statements or questions. It's tough for me to understand that. Can FHA be used for investment properties? Yes. So under a conventional loan, the bank is protected by, boy, I missed it, by the PMI, and under FHA, the bank protected by the FHA. Yes, by the MIP. So are all FHA loans? No, that's only one example of an FHA loan. I was using that as an example. You said it's three parties, right? Yes, each is the bar. No, it's the bank, the FHA, and you. That's the three parties. You're borrowing the money from the bank. The FHA is offering an insurance program to the bank to protect them against loss of equity. The conventional loan is a two-party transaction, you and the bank, and that's it. FHA, MIP can only be canceled when the loan is paid off or refinanced, not like conventional. Correct. So typically they refinance So typically they refinance to drop the MIP to 8% LTV so they don't keep paying MIP for life. Remember, they can't refinance to another FHA loan. It must be into a conventional loan where no PMI will be required if you have a minimum 20% equity in the property when financing. Is this only for first-time home buyers? Just more popular with first-time? You can use FHA or conventional whether you're a first-time or experienced borrower. It doesn't matter. It's just the type of loan we're talking about. What closing costs can you finance under FHA? Most closing costs except realtors' commissions and attorney fees and things like that. Points, can't pay those. They can't finance those. They must be paid up front. So are all FHA loans? No, that's only, again, one example. This is just for the first-time buyers. This is one program under FHA guidelines that we're talking about. It says 203B is the most popular, not the only program, the most popular. Can you buy with FHA and then rent out the property? Yes. If in an FHA and you refinance, it has to be a conventional loan. Doesn't have to be, but to avoid the PMI or the MIP, yeah, you probably want to go to conventional. Conventional FHA or VA loans. That's the only type of loans we're talking about of the three categories. Boy, does the lender drop PMI automatically upon the loan reaches 20 or 22%? Under a conventional loan, the lender is required to drop the PMA charge after 22% equity portion has been revealed or a minimum of 78% LTV is achieved. Again, let's move on. I don't see any other questions, and I do want to keep going because now I got like 15 minutes to complete the FHA and the VA and the other programs. So reminder, once again, a conventional loan, two-party transaction, you and the bank. FHA, three-party transaction, you, the bank who makes the loan, and the FHA who insures the loan to the bank. Then there are VA loans. Now, this is going to take a few minutes, so we're not going to get all this done before lunch. I don't think so. We'll finish it up after lunch. VA guaranteed loans. To qualify to get a VA loan, Veterans Administration, number one, you must be or have been a service member of the U.S. military. Upon your discharge, you must achieve a minimum of an honorable discharge. Then get your certificate of eligibility by applying by using a DD-214, etc., to the VA administration. And they will qualify you with a certificate of eligibility for your VA benefits. Once you achieve that, you can apply and get a VA guaranteed loan. So stop and think about it for a second. If you're a veteran or know of one who qualifies, in order to qualify, the veteran must have as a status under their belt no less than 90 consecutive days of active service during wartime, or 181 days of active service during peacetime, or a minimum of 6 years in the reserves and or National Guard. Meaning, if you have met those criteria and have achieved an honorable discharge, you can qualify for the VA benefits, which include the VA loans. This also applies for in-service veterans who are still employed in the military. However, they still must apply for the certificate of eligibility like any other candidate. The use of the VA loan is for any qualified veteran who meets those criteria, or the only other person that can access benefits under VA is the unremarried, widowed spouse of a service person. So husband and wife, wife's in the military, husband stays home. The wife dies as a result of her service to the country. The husband, who does not remarry, can still qualify for her benefit. So an unremarried, widowed spouse can still access their spouse's VA benefits if their spouse dies. That's the rule. Sons, daughters, cousins, nephews don't qualify to get VA loans. Only the veteran or their unremarried widowed spouse can qualify to get a VA loan. So what is a VA loan? A VA loan is made by commercial lenders, just like the bank just does an FHA or a regular conventional loan. But the VA is the third party in the transaction. They're not going to insure a 20% equity portion in the bank. What the VA does, however, is insure up to a 25% loss of equity to the bank should the veteran default on their mortgage. In other words, if I'm a bank, I would want to make as many VA loans as possible, because if the veteran defaults, the VA pays for the 25% equity exposure I could experience if they default. And here's the most incredible thing about VA loans: zero down payment options. That's right. If you're a qualified veteran and you get your certificate of eligibility, you can find a piece of real estate, whether it's for your personal residence or an investment up to 4 families, they qualify. You can buy a house using zero down payment money from the bank through the VA program. Now, I'm going to just try to give you an insight on how a veteran can build financial and real estate wealth very quickly. So those of you who are eligible under VA programs, first of all, if you're a veteran, thank you for your service. We owe you more than we actually give you, but thank you for your service. If you qualify or you know somebody in your family that can qualify, they can buy a 1 to 4 family residential property so long as they agree to live in the property with zero money down payment. So here's the scenario. Let's say you're an active or you're a retired veteran. You decide you're like 25 years old to start your investment. You can qualify under your VA eligibility to buy, let's say, a 3-family house with zero down payment. Your tenants, through paying you rent, pay the loan off for you, as well as all the expenses on the property. Your job, whatever that is not going towards paying bills, so you save your income. Several years later, you decide to refinance that VA loan, and the VA now, believe this one, will refinance up to 100% of the current value of that property. In other words, that veteran can cash out on the refinance, take the money out of the property along with their savings from their job, and buy another 3-family. Do you see where this is going? Guys, if I had to do it all over again, that's exactly what I would do. If you're a veteran and you're looking to get into the real estate markets and build wealth, this is a very low risk effort issue on your half. To buy a multifamily, live in it, have your tenants pay all your bills, save your money from your job, and several years later refinance the property for 100% of value, take out that equity along with your savings, buy another house. It's incredible how often you can do this and additionally build wealth quickly. That's just a hint, guys, just saying. So under the VA loan, the veteran who qualifies can buy a 1 to 4 family residential property, live in it with zero down payment if they qualify. And all they have, there's no mortgage insurance premium or PMI or anything. They only pay a one-time funding fee based on the acquisition cost. And one of the most attractive things about a VA guarantee loan, they are 100% assumable even by non-veterans. Meaning, if you're selling your house as a veteran, you bought it with a VA loan, that buyer who wants to buy your house could actually assume your loan by qualifying with the VA about income levels. And if they do, that non-veteran can assume your financing, pay you cash difference for your house, or get a loan and pay you the difference. They can buy a house and you just realize your profit on the resale of the house and can go on and do something else. Veterans can reestablish their eligibility once loans are paid off or assumed. And the VA will, in very rare cases, make more than one loan to the veteran if it's an emergency scenario. So this veterans program, guys, I got to tell you something. If you're a veteran and know of one, use the VA programs. It's the most beneficial thing that they offer, believe me. So don't you have to be an occupant of the owner of a FHA? Yeah, it says that right in the application. And yes, you can buy investment properties with FHA loans. They have what's called a 203K loan and other style loans. You can buy investment properties in a 203. You can buy a multifamily with fixer-upper costs included in the loan. It's the most incredible program, 203K. Was there other questions? How many VA loans can one have? A maximum of 2 at a time, and that's only under emergency conditions. Usually it's only 1 at a time. Dishonorable discharge, veterans don't qualify. Correct, Arson. Is there a maximum the VA will provide for a loan? 100% of the value of the property. You mean dollar-wise? Yeah, I believe it's 3 times what an equity portion maximum will be allowed. In New Jersey, I think that's about $90,000 or so. But, no, excuse me, that's wrong. Under FHA, it's whatever the average mean sales price of a home is in the county where the loan is being generated. I'm sorry, I missed something. So 100% assumable even by non-veterans. Can you explain how the buyer assumes the loan again? By applying financially to the VA to see if they can meet the payments. And if they can assume the loan. Does credit score matter? Obviously, yes. Your ability to repay matters, yes. How much you make in income matters. A 0% down payment is an option. You may have to put down money if you don't qualify because you don't make enough money for the payments. But buying a 3-family, here's the thing about investment properties, guys. If you're buying and living in an investment property, you can use up to 75% of the generated income on the property as qualifying income for you to qualify for the loan. Just so you know. Are they able to sell their house that they got with a VA loan and the buyer their next house and get another VA loan? If they can establish their certificate of eligibility again, yes, they can. But they have to reestablish that certificate. Excuse me. All right, I'm not seeing any other questions. So there is investment property, 75% of income for qualifying income to qualify for the loan. So let's say the property generates $100,000 in income as income. I can use 75,000 of that as qualifying income for me to qualify for the loan to buy that house. So you can use multi-family investment properties that you're going to live in and take up to 75% of the generated income as qualifying income for you to qualify for the loan on top of whatever else you make. All right, moving on. There's also the New Jersey Home Buyers Programs. There's the New Jersey Housing and Mortgage Finance Agency, which offers below market interest rates with little or no down payment options. But this is only to low and moderate income earners, so you must qualify under maximum income amounts. And it's mostly for first-time home buyers, and these are for properties that are to be bought in certain urban target areas. Maybe not so desirable areas. And therefore, a lot of people don't take advantage of this program because they don't want to live in areas where there's very high crime, drug use, gang activity, and that stuff. And that's usually where these urban target areas are located. You can apply through many local lenders to find out if they have programs that will help you under the New Jersey Housing and Mortgage Finance Agency. And then there's also what is used to be called the Farmer's Home Loan. The Farmer's Home Loan was usually money available through the FDA, Federal Department of Agriculture, to buyers of farms. However, in New Jersey, not too many people still buying farms. They're buying houses. So they changed the program and now call it the Rural Economic Community Development Program. For low income and first time buyers, mortgage interest can be subsidized for as low as 1%, and only modest homes qualify. All these sales for those programs are handled through local lenders as well. I'm sorry, through the Department of Agriculture. So that's a direct lender, the FDA. There is a web address under Farmers Home Loan that you can access, the USDA.gov/topics/rural/housing assistance to find out more information. So in effect, we've talked about mortgage financing and the concepts of leveraging, using other people's money, points, interest, fixed rates, adjustable rates, and different programs. We talked about home loan toolkits, FDA loans, the New Jersey home buyers programs, VA loans, FHA loans, and conventional loans. Before we break for lunch, because I technically have just ended the chapter, I'm going to pull up the review questions after lunch, but does anybody have any follow-up questions to these topics discussed? So an investor wouldn't use the program, or they could, I'm sorry, what program are you talking about, David? Just to confirm, a VA loan is a three-party loan. Yes, you, the bank, and the VA. Now, remember, under FHA and VA, the banks make the loans. FHA does not loan money. The VA only lends money in very rare cases. And then if a specially adapted house must be used for the veteran. And that's the only case they would lend money directly. Can you put up the last slide? Oh, it's already taken down. Sorry, guys. It's in your book. All this stuff is taken directly from your book. What's the most important to know about New Jersey home buyers section? Well, you got the New Jersey home buyers program for urban target areas, low and moderate income earners, 1 to 4 family dwellings qualify. Farmers home loan, subsidized interest rates as low as 1%, and it's for low and moderate income earners. And it's done, and that was done through the FDA. Tim, can you just quickly review the 3 scenarios to qualify for the VA and that you were as far as service? You went over as far as service. Oh, okay. It's right in your book, and I'll direct you to the page. It's on page 246. We're under eligibility. 90 days consecutive service during active military or active wartime. 181 days during peacetime of active service, or 6 years in the National Reserve, or the reserves or the National Guard. Those are the 3 scenarios. Please go over assumability. A VA loan is 100% assumable even by a non-veteran, which means if they can qualify, they can take over the loan from the veteran, and the veteran is discharged of all responsibility of the loan once it's assumed by the new borrower. Okay, I think I filled in the blanks, and it is 12 o'clock, so hopefully if everything goes smoothly in the next minute or two, Lauren or Noel will come on and talk about any administrative questions you may have. But for the next hour, I'll be missing and having my lunch and, betting on stock markets and stuff, or maybe not. But I'll see you at 1 o'clock. Stand by if you got admin questions. They'll be online in the next minute, so I'll see you at 1.